So the good news is the banks, the ones that are still left, a lot of people have gotten rid of their CMBS staff or are cut back dramatically or written off the year. But this year, this week, Credit Suisse announced that they're stepping back into the market. Lehman Brothers, we've been in meetings all week. We're strategizing to come back in the market in the next couple weeks and start lending again. And the new rules will be, probably smaller loans. You'll probably see stuff getting done like 50, 40 million and under for the time being. And then as investor confidence builds, people will probably start raising that bar. And, the loans will have coverage on an amortizing basis, and they'll be a little bit more expensive. I still think stuff will be 6.5%, 7%, but that's pretty good if you look at it. And I think we'll start to see the machine start to move again.
Bob, coming from a legendary Sonnenblick lending family, what do you have to say?
Well, it was interesting to hear the last panel talking about, and even Mark's comments about the problems in the market now. I've been public with my feeling that this is a short-term incident, what's going on right now. I am convinced that in spite of all the layoffs in the CMBS firms and things like that, that is, those of you that are at this same conference in a year from now will look back at it, and it'll look back as a very unfortunate, uncomfortable time, but the CMBS market will be, say, a year from now, actively working just as active as it was a year ago or 2 years ago. There's no reason why all of a sudden, you're happy about that, Mark. There's no reason why the concept of real estate lending should disappear. The previous panel, Phil and some of the guys talked about fundamentals in the real estate industry not being bad. I agree, Barry, with that 100%. I'm a little bit more pessimistic about where the economy is going over the next year. I think it will not be so much of a soft landing as was referred to in the previous panel, but even regardless of that, there is no reason that the concept of real estate loans should not exist. And I think if Mark, as Mark mentioned, and those of you that are in our business, the real estate lending market really has stopped for the last 9 months. The numbers will show you that. One of the other things, though, that's come out that's a positive from all of this, and again, the reference was made before about spreads, things got really stupid last year. I mean, we're all a part of the industry, and if we're honest with ourselves and look back at what went on throughout most of 2006 and 2007, the spreads that deals were being done at really were stupid. Anytime you look at any kind of a real estate deal, and we all heard about some of the big mega deals especially, where spreads were under 100 basis points on treasuries. I don't care how good your A piece is and things like that. That's stupid real estate. It shouldn't be that way. So the pendulum has actually swung too far in the other direction. There will be corrections. I laugh when I hear numbers about 350 over. I think, again, that's hopefully just a temporary thing. But if we're all able in the future to borrow at 200 over, whether that's 5, 6, or 7, let me tell you that from experience, even if you're borrowing at 7%, real estate works at 7%. Real estate works at 7%. Most of us started in the business when rates, long-term fixed rates, were 9 and 10%. And if you had spoken to any of us back then and said, hey, I've got a 7% loan for you, we would have been ecstatic. So even with T-bills at 3.5, even at spreads at 3.5 on top of that, if you're at 7, less amortization, we all have nothing to complain about. And I think it will be very, very soon once the lending community, with the help of the rating agencies who got beaten up pretty badly in the last go-around. I really foresee this. I hate to sound so optimistic amongst everybody who's so gloom and doom in our industry, but I really see this, Barry, as a very short-term thing, and come January 1, you know, we'll all complain about spreads, but there'll be money and everybody will be back in business.
You buying real estate?
I am, actually. It's interesting, this is an international discussion. We are actively developing projects, but not really in the U.S. We have gone to places like the Caribbean and Mexico, where we're doing large resort hotel projects, because again, tied to previous discussions, I can't buy land in the United States and have the deals pencil out. The numbers don't make any sense. If you're looking to do a development deal and make a 9 or a 10% unleveraged return on cost, you still cannot do that in the United States. In the major cities, Barry, you're in LA, I would assume the same is true where Mark is in Boston. You can't buy land in the downtown core and make your deal pencil at a 9 or 10% return on cost. Until that does happen, we're going to stay in places like the Caribbean and Mexico because we're just priced out of the U.S. market.
Unless your base currency might be the pound or the euro.
Right. Well, that's the one thing that we're seeing in the Caribbean. You're absolutely right. The competitors we run into in the Caribbean are largely UK and Irish funds who are playing with the euro. And again, they have a huge advantage in that it's heavily discounted. And we'll probably end up selling to them when we finish our developments.
There is a tremendous amount of fund formation that's going on in Europe now. And by the way, just as an aside, the Middle East, U.S. is not particularly involved in investing in the Middle East. In fact, not a lot of people are that involved in the Middle East because of the risk premium that they're not willing to tolerate. But because of the currency, the people who are starting to move to the Middle East right now are UK and Europeans because of the currency situation. The Middle East, generally the currency is pegged to the dollar. Jay?
Well, that's not the lead-in for me, but okay. No, the currency pegged to the dollar, but
yeah, I'm sorry.
But I can flow with this, no problem. My name is Jay Rollins. I'm with JCR Capital. We're private capital, and we do just opportunistic private deals, whether it's debt or equity. And people are asking me all the time right now, well, what kind of deals are you doing? And my stock answer is those that I can get repaid. Because that seemed not to be very popular the past few years. So people really didn't care about getting repaid. Since it's our money, we actually care about it. But to go off of Bob's theme, I think you really have to put real estate loans today in 3 separate and very distinct buckets to say what's going to happen and what's going to work. And what we've heard so far on the panel is a fixed rate CMBS. And I would totally agree that's going to be the first thing that comes back. It should come back. It's going to come back, kind of like it started. If you remember, this all started as a way to move paper out of the RTC in the early 90s. And it was a very much of an alternative to a life company, a little bit more expensive, a little bit lower quality, and it was a vehicle that was very static, and it worked. And we got carried away and started running away with it.